On the one hand, I don't believe that SVB by itself was a systemic risk to the system. On the other hand, there was clearly contagion going on.
The U.S. banking system remains resilient and on a solid foundation. The board continues to carefully monitor developments in financial markets and across the financial system.
I think there will be an effort to push down some of the regulation that currently applies to larger banks down into the smaller banks. I myself think that for the most part, that will probably be a mistake.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 5 a.m. in New York, 9 a.m. in London, and 5 p.m. in Hong Kong. Our top stories today. A pleasant surprise for Bank of America. The firm ranked in more than $15 billion in new deposits in a matter of just days, emerging as one of the big winners after SVB's collapse. The Federal Reserve is considering changes to its oversight of mid-sized banks, stress tests, capital and liquidity structures, all under review. Plus, in the UK, Chancellor Jeremy Hunt will pledge to drive growth by unlocking business investments in his first UK budget. His speech will be set against a backdrop of mass worker strikes today. Welcome to Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in Paris today. Matt Miller is off now. Anna, I'm here in New York. Not a ton happening in terms of excitement in the city, but you're in Paris. What takes you to Paris?
What takes me to Paris is the Bloomberg New Voices program, so an effort by Bloomberg to increase the range of voices that speak to Bloomberg TV. Kriti, so watch this space. New voices coming shortly to Bloomberg Television. In the meantime, back to the markets.
Yeah, back to the markets. I mean, I'm a little jealous of that assignment, Anna. I have to admit, I want to go to Paris. I've never been. I really should go visit. But meanwhile, stateside here in the markets, we aren't seeing a ton of conviction in either direction. In fact, futures are only down about 0.2%, a little bit weakness in the equity market. But I got to say, I think that's a theme we might just be seeing worldwide. Stay tuned. Anna's going to walk you through the European action in a second. For me, it's all about the bond market. The two-year yield kind of grew, rising once again. Remember, it retreated pretty heavily back from that 5% level. We're now at 4.33, a move already overnight by about 8 basis points stateside, and that, of course, taking with it some dollar strength. One of the biggest contributors to that dollar move higher is the Japanese yen. We're looking at a 134 handle for that currency pair. Certainly something you want to watch, even though the Nikkei itself overnight really unchanged. So some interesting dynamics happening over in Asia, not necessarily bleeding into the pre-market U.S. session. Bitcoin, though, we have to keep an eye on it as crypto becomes a big part of not just the SVB collapse, but perhaps the Signature Bank collapse as well stateside. To what extent does that is included in the regulation review? Nevertheless, it doesn't seem to be stopping investors from piling in. Bitcoin shares, Anna, or Bitcoin, I should say, in general, higher by 1%. What's going on in Europe?
Yeah, let me tell you what's going on in Europe. Here in Paris and elsewhere in Europe, we see weakness across European equity markets. The stock 600 down by around 0.8%. So what seemed to be some line in the sand, maybe a little bit of resilience in the market psyche at the start of the trading day, has quickly deteriorated. The CAC 40 here in Paris down by 1%. The Xetra DAX down by 0.5%. Elsewhere, the IBEX and the FTSE MIB down by more than 1.5%. We continue to see weakness as a result of concerns perhaps around SVB, concerns perhaps around the banking sector in Europe. And let me get to that right now for you. Credit Suisse, you can see down on the board there, down by 5.3%. Top shareholder, this is the Saudi National Bank, top shareholder in Credit Suisse has ruled out more assistance to the bank. As a result of that, we are seeing some weakness in the share price as we speak. So that one moving as a result of those news lines. We'll get a further update from Saudi Arabia, where Bloomberg TV has been speaking to that bank shortly. We've also got the German two-year yield in there, just showing you the bounce back that we're seeing in yields. And we're seeing that across various geographies here in Europe. We're seeing it in Italy, in France, in Germany. And perhaps that is also something that is weighing on sentiment, along with the banking story. Also weighing on sentiment is news out of the likes of H&M in the retail space. We've got a disappointing, described by some analysts as disappointing today, update from H&M. Bolloré, I put this in here just because it's the biggest gainer on the stock 600, and it is French, and I'm here in Paris. A diversified business across a whole host of industries, including media. A tender offer for nearly 10% of that stock, and so as a result, the best performer today. And the Brent price, worth mentioning, up by 1%. We got news lines at the top of the hour from the IEA saying that the energy market is now in surplus. Russia pumping more crude, and as a result, in surplus. We will get, we've seen, though, before that news hit, we'd seen resilience in the oil price, and we continue to see that as a result of the Chinese data, which showed a recovery from from some of the COVID period, of course, Chrissy. So that's certainly in focus.
Yeah, certainly in focus, alongside, of course, all of the moves and the continued fallout or perhaps continued success for a lot of banks following the collapse of SVB and some others. Bank of America, for example, mopping up more than $15 billion in new deposits, and it just took a couple of days. The Wall Street giant has emerged as one of the big winners after the collapse of three smaller banks, denting confidence in the safety of regional lenders. Valerie Teitel, Bloomberg Markets reporter, joins us now. Valerie, $15 billion. That is no small amount to scoff at.
$15 billion, Critty, in a matter of days. The big question for the markets and for the banking sector going forward is just what, to the extent this deposit flight from the regional banks into the too big to fail banks, what extent will that continue? And how will we know about it? Bank of America was the first one to throw out a big number, $15 billion, but we have yet to hear from the likes of JP Morgan, Citi, Wells Fargo, just how much have they raked in. We do get a weekly number from the Fed in terms of commercial bank deposits. It's broken out into the top 25 large institutions versus the smaller institutions in the banking sector in the U.S. We get this updated data next week. Will it show a huge shift? And in the weeks and months to come, will that trend continue? That is the big question for regional banks. Their business model is coming under a lot of pressure from these deposit flows, but they're also competing with money market funds, which are returning a juicy 4%.
Yeah, so if we're seeing some money coming out of, or going into the big banks rather, and coming out of some of these regional banks, this deposit flight, as we maybe describe it, at least in part, Valerie, what does that point to? Does that point to a larger take-up of the Fed's new lending facility? How do we work all that in?
Anna, it possibly could, especially if this trend continues and these regional banks continue to lend on, continue to lean on this new lending facility. Now, remember, this lending facility had some pretty generous terms. There was no haircut on collateral, and these regional banks could mark those securities at par when they repo them versus the Fed. We get updated data on the Fed's balance sheet tomorrow evening. The big question is just how many months of QT could this lending program undo? A lot of people were very confused about the rally in equity markets yesterday, but maybe it's because they are reassessing the new lending facility, seeing it as a QE trade. And we know that QE has buoyed equity prices over the last year, and perhaps the market is just reassessing what this lending facility could mean for risk assets.
Bloomberg's Valerie Teitel walking us through a pretty complicated issue in the markets. We thank you as always. Meanwhile, the Fed said to be considering changes to its oversight of mid-sized banks following the collapse of those three lenders over the past week. Regulators at the U.S. Central Bank weighing bringing capital and liquidity thresholds closer to those that apply to the big Wall Street firms. Randy Quarles, former Fed Vice Chair for Supervision, played down the role of those looser rules in Silicon Valley Bank's collapse. Take a listen.
I think there will be an effort to push down some of the regulation that currently applies to larger banks down into the smaller banks. I myself think that for the most part that will probably be a mistake driven by a misunderstanding of what just happened. I think there are interesting questions about how to improve regulation in light of what happened, a lot of which have to do with the treatment of uninsured deposits.
Michael Moore, Bloomberg finance editor, joins us now for more. Michael, a lot to digest here. Things happening very quickly on the regulatory front, which is almost a highlight in itself. Are we essentially expecting some sort of Dodd-Frank 2.0?
Well, I think it would be more of applying Dodd-Frank to more banks, and the stricter elements of that. Right now, there's kind of 4 categories of banks within the Dodd-Frank regulations. And, category 1 are the names that we know and are the ones that have the most attention. But if you look at the stress tests last year that were published by the Fed, it had 34 banks in it. Will we see that number go up as smaller banks get added in there? SVB was not subject to the liquidity coverage ratio that other banks have to do that says you have to hold enough liquidity to cover a month of outflows based on your best guess of what that could look like in a stress period. SVB, because it didn't have much wholesale funding, because it was mostly deposits, wasn't subject to that. But are the regulators going to reassess that now that we've seen that deposits are perhaps not as sticky, especially when they're uninsured and from a concentrated base?
Yes, absolutely. A lot of reasons perhaps to revisit those rules, as we were hearing. Michael, in amongst all of this turmoil in the banking sector, we're also hearing about strategies around pay, in particular from HSBC, or reporting tells us this. What do we know?
Yeah, so what we're reporting today is that many people that were just promoted to managing director, so the highest rank at HSBC, got a smaller salary than what's typically been given to that level. And I think what you're seeing here, as the UK removes the bonus cap, some of the banks are using that to lower salaries or reduce the salary growth to try to adjust to that and move to a model like we've seen in the US, where salaries are a little bit lower, but more of the comp is in bonus. So we'll see if other banks follow suit, but this was definitely something that we've been wondering since last fall, when the UK moved in that direction to get rid of the bonus cap that is in place in the EU. Were you going to see that mix change? And I think we're starting to see that sign.
Okay, thank you very much. Thanks to Michael Moore, Bloomberg's Michael Moore, with the latest on some themes in the banking sector. Sticking with banking, in fact, Credit Suisse's top shareholder has ruled out providing more financial assistance to the struggling Swiss bank, citing regulatory issues. Bloomberg's Yousef Gamal joins us now with more. And Yousef, I see that the share price of Credit Suisse actually touching a record low as a result of this, and these news lines that you bring us, down by 6% in session today. Yousef.
Yeah, Anna, so I caught up with the chairman of Saudi National Bank, and his tone on Credit Suisse specifically, far from the optimism and confidence when we broke the first interview back in late October into early November of last year. The thing to remember here is that they're seeing these regulatory obstacles that are going to keep any participation on their part quite limited. But there was clearly also no interest to go beyond into any other creative ways to support. I asked about the franchise, Credit Suisse First Boston. He says, no, we're not going to take part in that either. And some of the other conversations I've had here on the sidelines suggest that there's a growing sense of frustration that despite a lot of the regional support and very much being front and center as part of the Credit Suisse overall into late last year, there is disappointment and a sense that, you know, we've done our part and the rest is up to Credit Suisse. Take a quick listen here in terms of what he had to say.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
I mean, you have a clear answer there. The credit default swaps have blown up. The stock is flirting with 2 Swiss francs a share. It's down 25% in the span of a month. And for Saudi National Bank, this is still quite a small exposure. So it's not a concern for the bank as a whole, but it's no longer an interesting play, even though they were touting some integration benefits to the Saudi growth story. Guys?
Bloomberg's Yousef Gamal with some breaking news really moving the markets there. We thank you, as always, for that context. Meanwhile, we should probably stick with what's going on in the Middle East at the moment. Abu Dhabi firm G42 valuing ByteDance at around $220 billion, much less than the $300 billion set during a recent share buyback program. Joining us now is Masson Mills in Dubai. Maddie, how significant is this change in valuation? Walk us through Abu Dhabi's involvement here.
Yeah, Kriti, so going from $220 billion, like you said, we have to look at the context here, right? The peak valuation for TikTok came in 2021. That number was $460 billion. The latest valuation coming in at $300 billion when it set its own share buyback program. So this $220 billion valuation coming as a bit of a big discount when it comes to the ByteDance deal here. Now, looking at the reasoning behind behind the jitteriness in that valuation, we think of regulatory concerns, right? In the United States, as you know, there are a lot of questions about the security of TikTok, specifically owned by ByteDance, and what that looks like kind of remains to be seen. In terms of the Middle East, though, Abu Dhabi's G42, it's an AI firm here. This could be a sign that the Middle East is willing to bet on China's economy rebounding. This is a $100 million purchase of these shares in a private market purchase. And this comes from a firm that is known for being on the forefront of these tech innovations. So could be a bet on China booming moving forward.
Okay, if this is a bet on China, Madison, then it raises the question of just how Chinese TikTok is. And this comes as TikTok has considered splitting off from ByteDance if US regulators don't approve the company's existing security proposals. What do we know here?
Yeah, so that split would only be a last resort, according to TikTok. But we know from our Bloomberg reporting here that those regulatory concerns have pushed TikTok to create this Project Texas plan that really pushes an implementation of a number of changes, including one of those changes being Oracle hosting U.S. user data and reviewing its software. A big internal review and external review as national security officials look into the security of TikTok. Whether or not that deal gets done and U.S. officials are okay with those changes is the big question for TikTok. They say that if that deal gets shot down and officials aren't happy with it, then they are potentially going to move forward with a divestiture. And if they do that, our analysts say a sale or IPO could be valued anywhere from $40 to $50 billion. And maybe the likes of Microsoft would be interested, particularly if that Activision deal falls through.
Madison, thank you very much. Bloomberg Quick Take reporter Madison Mills there with the latest on a few tech themes, well, both involving TikTok, in fact. Coming up on this programme, the monthly oil report is out from the IEA. We will speak to Toril Bosoni, the IEA's head of oil markets. The report this morning saying that the market is in surplus as Russia pumps more crude. We'll dig into those headlines. We'll talk about Russia in energy markets. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in Paris today with Kriti Gupta in New York. Let's talk about oil markets. Global oil markets are contending with a surplus as Russian production defies predictions of a slump while fuel demand slowly picks up. According to the IEA's report out this morning, that's the state of the oil markets. Joining us now, Toril Bosoni, who is the IEA's head of oil markets and a great person to speak to then about a market in surplus. Toril, thank you very much for joining us. So you say this morning in your report that the market is in surplus as Russia pumps more crude. In fact, you say that inventories have surged. Do you see anything that changes that? Do we remain in surplus for a period?
Good morning. Yes, no, we're starting off the year in relative comfort. As you know, Russia production has been holding up very close to pre-war levels. The price cap that has been put in place has allowed the Russian oil to divert to new buyers in Asia mostly, as it getting back out of Europe. But we're also seeing that demand already in the fourth quarter of last year declined year on year, and we're starting with weak demand at the start of 2023. So looking forward, we're expecting a sharp recovery in oil demand this year. From the first quarter to the fourth quarter of 2023, we're expecting an increase of more than 3 million barrels a day increase in oil demand as China economy opens up after COVID restrictions are lifted. Jet fuel continues to recover after the COVID slump. And that increase will be difficult or be challenging to meet. So we could very quickly see the market shifting back to deficits as the year progresses.
Okay, so we're in surplus right now, as you described, but there is demand coming back quickly, Toril, so things could get more difficult later in the year. You mentioned Russian supply in your report, and I wanted to ask a detailed question about Russia. We see a big spread between the price of Russian oil when it's exported and the price when it's imported. I wonder if you have a sense of where that money is going? And are you confident that that money isn't ultimately returning to Russia? Are we saying here that there's a freight and logistics bill of around $20 a barrel, which is the difference perhaps here? Where do you think that money is going?
Well, it's a good question. This is something that we looked into in detail. Of course, we're tracking very closely both the price that Russia is getting for its crude and product exports and comparing that to market prices for non-Russian grades. And we are seeing a big discount. We're also looking to see what countries are paying for their oil in terms of what they're declaring to customs, both in terms of volume and value. And it is clear that the freight rates, the shipping costs, the insurance costs have surged, and there are new buyers, there are new players emerging outside of the European Union, because as you know, maritime services provided by the EU would only be allowed to be used to transport this oil if the oil is traded under the price cap. So exactly trading companies, shipping companies, insurance companies, both Russian-linked or in new jurisdictions, but also the traditional sector are getting part of that extra revenue.
Toril, you mentioned the price cap specifically. Are there further steps to take on that front? Have they really proven as a success?
I think so. I mean, the aim of the price cap is to limit revenues that Russia receives for selling its oil, but at the same time allowing the oil to flow. As we see, Russian oil is flowing to market. In February, we saw 500,000 barrel decline in exports from Russia, but from a very high number in January, just ahead of the latest product embargo that came into effect. But what we're seeing is that the revenues, Russian export revenues in February were down almost $3 billion, 2.7, to the lowest monthly number since the start of 2021, and down more than 40% on a year ago. So I think we can say that the price cap is working. Oil continued to flow. Buyers in Africa are now picking up product exports at a cheaper price. And this was the intentions of the price cap in the first place. Now, going forward, the price cap will be reevaluated every 2 months. There is a process underway from the price cap coalition. So it'll be interesting to see if the price cap will be set lower for crude or for products as the year progresses.
Well, Toril, let's talk about another one of the global stories. Of course, in the last week or so, we have seen the collapse of Silicon Valley Bank kind of trigger collapse and concerns around the world in the financial sector. Are you seeing any sort of read-through into the oil market?
Well, we've seen oil prices come down over the past few days, and it's very much linked not only to the surplus that we're seeing in the market right now, but to the concerns about the macroeconomic environment, the financial sector, how the collapse of the SVT Bank will feed into the broader financial sector and what implication will have on economic growth going forward. This obviously will have an impact on oil demand going forward and the balances. So this is something that we're watching. The latest price moves that we've seen very much linked to the concern and not so much any physical impacts from this collapse on the oil markets, but continued concerns about the economy, interest rates, and steps that governments might put into place.
Okay, so that's something you're watching. Can I ask you about the French side of this? The French strikes, which I'm in Paris today, you're in Paris, French strikes taking place, of course. Is this going to have an impact on oil product supply? Will France need to import a lot of oil products to compensate?
Another good question. We all remember the strikes back in October when the French refining sector and distributions of products was halted for many weeks. Now, of course, there are renewed strikes in the refining and delivery of products, but I think the stockholding agencies, the governments, the retail stations are better prepared this time around. So there fuel seemed to be available at gas stations for the most part. We've seen very limited disruptions to the supplies as of yet. And now it will all depend if the strike at the refineries and distributions will step up, including more sites and how long it would last. But of course, we hope that we will avoid the situations that we had.
Toril, of course, something, and we're
year.
going to have to cut you off just for time, but thank you as always for joining us. Folks, stick with us. Toril Bosoni of IEA. More coming up. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A pleasant surprise for Bank of America. The firm raked in more than $15 billion in new deposits in just a matter of days, emerging as one of the big winners after the collapse of SVB. Credit Suisse's top shareholder ruled out providing more financial assistance to the struggling Swiss bank, citing regulatory issues.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
Plus, Chancellor Jeremy Hunt will pledge to drive growth by unlocking business investment in his first UK budget. His speech set against a backdrop of mass worker strikes today. I'm Kriti Gupta in New York with Anna Edwards in Paris today. Matt Miller is off. Anna, it's an exciting day around the world, but I've got to say, I think you have the best assignment maybe in Paris.
Yeah, perhaps I do. Perhaps I do. Nice to be in Paris, launching a Bloomberg initiative to try and broaden in Paris the number and variety of guests that we bring to Bloomberg TV. But thinking about the variety of guests, we just had that incredible interview with the Saudi National Bank, Kriti, which seems to be moving share prices here in this part of the world, certainly moving the banking sector, moving the Credit Suisse share price down by 9% this hour. Certainly a story we keep under review. What else are you seeing in the broader markets?
Well, we got to see if that kind of bank fallout that you're seeing in that part of the world is really echoing into sentiment here. And Anna, I got to say, you're not seeing that same volatility that perhaps you've seen in the last couple of days off the collapse of SVB and Signature Bank here in the States as well. But take a look at futures. They are certainly worsening. You are seeing the sell-off increase or snowball a little bit, down about 0.5%. Again, this is nothing compared to the sell-off we've seen in the last couple of days, but still, you're seeing risk sentiment is perhaps not as positive. The two-year yield, though, is what catches my eye. 431 on the front end of the curve, especially as we see varying forecasts on Wall Street of what we're going to get out of the Fed next week, as high as a 50 basis point hike from the likes of Citi, Morgan Stanley, to potentially a cut of 25 basis points as Nomura came out and say, nevertheless, that's pushing yields higher by about 6 basis points on the front end, 431 on that note. And as a result, pushing the dollar higher as well. Dollar strength higher only marginally by 0.1%. That's really where you're seeing a little bit of the change in the trade, because it was much stronger just 30 minutes ago, Anna. A lot of the move coming from weakness in the Japanese yen, the Asian session relevant in the FX space today. And of course, Bitcoin higher as well, up about 0.8%. But I wonder, as we talk about risk sentiment, at what point does that catch up to the risk off sentiment you're seeing in futures? That's the macro picture, Anna. Let me get you a few pre-market movers as well, because again, to your point, the banks are certainly in focus, perhaps not the big ones, the smaller ones. Western Alliance is the one that catches my eye. A big rally this morning, up about 7%, after Ken Griffin Citadel reports a 5.3% stake in the regional bank. Remember, this is a bank that has sold off somewhere between 60 to 80% in the last week or so. Their price to book ratio is just tumbling through the floor, making it a pretty attractive buy. You also have the likes of First Republic, PacWest as well, also getting a little bit of a bid. Once again, it is an easy buy when you look at some of the technicals and some of the valuations, higher by 11 and 4% respectively. But I'm going to take one step away from the bank sector and talk about AMC for a second. AMC Entertainment investors backing a share increase and a reverse split. How's that for a blast from the past, Anna?
Yeah, absolutely. Let's get back to the European story I was mentioning with the weakness in the banking sector certainly being a feature of that, Kriti. Let's have a look at the European equity markets. And broadly speaking, we're much weaker across these European equity markets, down by more than 1% now on main markets. So the Stock 600, the FTSE, the CAC 40, and the Xetra DAX all down by more than 1%. In particular, the French market down by more than 1.5%. Retail is one of the real areas of weakness, and that ties in with the H&M story. That's applying some weakness there. Disappointing numbers. But away from retail, the other two sectors that are weak, banking and financial services. We see the Credit Suisse share price down by 7.6%, touching new all-time lows today. It's been down by 9%. We had that interview, our colleague bringing us that with the Saudi National Bank, the SNB over there, saying they will not be increasing their stake. As Kriti, you were just showing in those headlines, you played a clip of him saying that they're not going to increase their stake in Credit Suisse. So that is something that puts some downward pressure on the Credit Suisse share price. The Brent price is resilient in the face of these IEA lines that talk about surplus, because, of course, they're talking about a fast return of demand later on in the year, which could push things into a tighter oil supply situation later on in the year. But broadly speaking, we do have a pretty negative session here underway, Kriti, for European equity markets. And it seems to be the banking sector, financial services, both of those doing particularly badly this morning. The Stock 600 banking index falling by more than 2.5%, led by BNP Paribas, though I should say that the Credit Suisse share price, of course, falls in a different sector in financial services rather than in banking, and that one also under pressure, down by more than 7%.
Yeah, a lot of things to keep in mind across the board when you're looking from the oil sector to the financial sector. How do you process it all ahead of the FOMC meeting next week? Joining us now to break it all down, Klaus Bader, Societe Generale Global Chief Economist. Klaus, always a pleasure to have you on the show. Look, in the last week, we've seen a variety of calls from banks around the world, ranging from a 50 basis point hike to a 25 basis point cut, really creating some pretty interesting and historic bond volatility. Klaus, where do you stand on that spectrum?
Well, I'll be honest, we changed our mind a couple of times too, though we didn't necessarily go to press with it. But no, we think, you see, there have been actually all these problems in the banking sector, but I think we got to think about, back to first principles. And I think that interest rate policy is there to control inflation. That's how central banks certainly see it. And you influence inflation through managing and manipulating demand. And on that front, the signs are pretty clear that the economy demands, both the US and the European economy, demands more tightening, more monetary policy tightening. We've had a very strong labor market report with some edges, but in the US, but it was a strong report. We've had a stronger than expected core reading on inflation, so we think the Fed is going to move. However, with the jitters in the market, is it really a great idea for the Fed to jump by 50 basis points or to re-accelerate the pace of interest rate increases? Probably not. So we're looking for 25.
So what is or should the Federal Reserve's priority be here? Should it be price stability for American consumers and, as a consequence, really the rest of the world? Or should it be financial stability right now, reinstating that confidence in the banking system and liquidity broadly? What's more important, price stability or financial stability?
Well, I think in the long term, price stability is definitely more important. And it's something that is much more closely in the remit and within the realm of the instruments that a central bank has, rather than financial stability. Now, financial stability, when it gets bad enough, of course, it impacts on the economic stability and therefore on the price outlook. But, fundamentally, we take care of banks and financial stability through regulation. And I think the Fed has done a lot, and in particular in concert with the other American authorities relating this, which is the Treasury and the FDIC. I think they've done everything to avoid a bank run, and that was really, or a wider bank run, that was really the imminent concern here for everybody. They've opened up a liquidity line to the banking sector. So I think as far as the Fed's action to stabilize the financial markets and the financial sector, they've done pretty much all they could do. And now it's time to think about their principal remit, which is price stability.
Okay, so we'll leave them to get back to price stability, perhaps. Let's see if that happens. Are you concerned that other things break here, Klaus? Have we seen what's going to break here in the global economy as rates go higher? Or are there other shoes left to drop to sort of mix those metaphors? We've seen the LDI crisis in the UK. We've seen the collapse of Silicon Valley Bank and others. Are we now looking at other crises? Some people mention real estate. Others mention leveraged loans. Where would your focus be?
Well, I think real estate is a really big issue because real estate valuation has gone up a lot through the period when central banks, were in all-out easing. So I think that's definitely a concern. I've been for quite a while concerned about private equity / venture capital, because I think to a large extent they're based on very low interest rates and very high equity valuations. And of course, those aren't there anymore. So I've been worried about that sector, private equity, to be the next shoe to drop. But, to quote a wonderful quote from Warren Buffett, It's only when the tide goes out that you realize who's been swimming naked. And when you do normalize monetary policy, you do raise interest rates. You know, what invariably happens is stress points come up. And they're not exactly black swans. They're known unknowns, but they are unknowns. And so we have to be on guard in that. And at the same time, it's not an argument to keep monetary policy at levels of expansion that are just totally unsustainable, because they're just going to create more vulnerabilities. That's at least how I see it.
Okay. Okay, we'll be reaching for our bathing suits. Klaus, thank you very much. Klaus Belder of Societe Generale, thank you very much for joining us. Very good to have you on the programme. Just a quick word on Credit Suisse. We mentioned at the last time we checked in, the stock was down by nearly 9%. Well, just to reiterate the pressure it's under today, that drop extending to double digits. The Credit Suisse stock extending its drop to 10%, hitting another record low. Coming up on the programme, we'll get back to other corporate news. BMW is positive on profit margins, part of our interview with the CEO of the German car maker. That's coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking at a live shot of the principal room. Coming up later today, an interview with former Federal Reserve Vice Chairman Alan Blinder. That's at 10:30 a.m. New York time, 2:30 p.m. London time. This is Bloomberg.
I see investment decisions more and more taking place to the detriment of Europe and actually also Germany, because we have clearly lost competitiveness with the higher energy prices, and we have not delivered any compensation for that. And so for me, unless we actually save more energy and get prices down, unless we work much harder to compensate the loss of competitiveness in energy somewhere else, we will not see the investments that we need.
The CEO of the German energy giant E.ON there, speaking with Bloomberg earlier. Of course, Germany's done incredible things to reorganise its energy mix over this winter, but now the CEO saying that the German economy is at risk of deindustrialisation, or at least that risk cannot be ignored. Meanwhile, sticking with Germany, we spoke with another executive of a big German household name. BMW said it expects 2023 profit margins around last year's level, between 8 and 10%. The automaker predicts the uptake in expensive vehicle sales to offset weaker pricing in entry-level models. Bloomberg's Oliver Crook spoke to the CEO about demand in the coming period. Let's listen.
Our order books are very high still. You know, we had high demand last year. There was not enough capability in the overall industry to satisfy that demand, and our order books are still full. And I think that will carry us through the next couple of months. So I wouldn't be too worried about the next couple of months. But then let's see how the work goes. The world stays volatile, but we foresee that there will be, overall, at the end of the year, there will be some growth.
And then in terms of, so we know the categories of growth, those are, a lot of that is going to be EVs, a lot of that is going to be the premium side of thing. I'm curious about geographically, where do you see growth being the big driver geographically for BMW?
We have three large regions. That's Europe, of course. We will have to see how Europe develops. Then we have the United States, where our biggest plant is located at. And we also see, with the product momentum we have there are possibilities also in the American market. In China, which is our biggest market overall, we see more positively towards the latter part of the year, where the whole market had a slow start, but you know, there's a new government coming in, customers are coming back from COVID restrictions. So we see more positively for China, but also, in addition, in the rest of Asia, we're more positive about that outlook.
And then in terms of EVs, you say high double-digit percentage growth. That's, you know, higher volume in EVs. I'm curious about margins. When do you think that EVs will achieve some of the similar margins that you see on internal combustion engines for BMW?
Well, first of all, we are not unhappy at all about the current margins in the EV business. We have a lot of cars also in the upper market segment, and I think this year, 15% share of our complete volume with positive margins is already possible this year. We don't sell cars with a negative margins, and step by step, with higher volume growth and higher economies of scale, I think we are quite positive about also the contribution margin of these cars.
Oliver Zipse there, the BMW CEO, speaking to our colleague Bloomberg's Oliver Crook, who joins us now from our Berlin studio. Ollie, what were the takeaways then for you from the BMW story?
Yeah, so we had the earnings pre-release a little bit. So again, it was all the focus on the outlook and everything, as we just heard from the CEO, it's all about growth drivers, which is going to be EVs and the premium end of things. So let's put a little meat on the bone there. So double-digit percentage growth on the high end. So that is really a very strong driver. Those are things like the BMW X7, Rolls-Royce, of course. And then in terms of the EVs, high double-digit percentage range. And of course, they also steered higher on the margins a little bit, which is another positive indicator. And despite a lot of the risks to the outlook, they say that they expect demand to be stable. And even in the first 2 months of this year, they saw that BMW was able to more than double its EV sales. So again, these are all sort of positive stories going into 2023. The question is, what happens in the back end of the year? You heard about the order books there. They're very, very strong. But the back end, I think there's a little bit less confidence that this is going to hold out through the entire year.
Well, Ollie, put this in some perspective for us. You had earnings from across the auto sector. What did we learn exactly about 2023 and what it's going to look like for the industry? And dare I even ask about 2024?
Yeah, well, listen, so this is the question. There's a bit of pull and push here. So you had all the tailwinds. 2023 was supposed to be a very strong year for the automakers. So all of the tailwinds, they include the backlogs that we were just talking about, premium, everything on the high end doing exceptionally well, driving growth, the U.S. being a very strong market, and China reopening. But again, a lot of them have said that they have not seen that China remains a very challenging market in the front half of the year. They hope that that improves on the back half. But then also with the supply concerns easing, while that helps the automotive sector generally speaking, what it also does is it helps across all the companies. So competition will also be rising. So does that mean that you have sort of the end of the pricing power for certainly the lower end of car makers? Slowing demand globally, inflation biting probably the middle end a bit more than the luxury end. And, you know, VW guided very strongly. UBS said maybe a little bit too strongly. And you have all of these unknowns going forward. So I think there's an argument for it to be a strong year, but also a weak one. Ifo did a survey of German automakers. They had the lowest sentiment for the last 2 years. So again, it's a little bit unknown at this stage, but it's certainly going to be a strong front half.
A mixed bag then for the autos. Thanks very much, Oliver Crook. Bloomberg's Oliver Crook reporting from Berlin on the German autos landscape. Coming up on the programme, UK Chancellor Jeremy Hunt will deliver his first annual budget later today. It's his first big budget, even if we've heard quite a lot from him since he took over after that mini budget we won't mention too much. More on what we expect next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in Paris today with Kriti Gupta in New York. Let's focus back on the UK, though. Later today, the UK Chancellor Jeremy Hunt will present the UK's spring budget. Bloomberg's UK political and economic correspondent Lizzie Burden joins us now from Westminster. Lizzie, good morning to you. What are we expecting from the budget today, then?
Well, Anna, it has felt a bit like Groundhog Day, but this is Jeremy Hunt's first budget officially as Chancellor. We're expecting it to be framed around 3 of Rishi Sunak's top economic priorities: halving inflation, growing the economy and reducing the public debt. So on the first, we've already learnt this morning that the energy support for households will be extended. We also expect him to freeze fuel duty, and then getting to the heart of the issue, the labour market inactivity that's pushing up inflation. We're expecting him as front and centre in the budget to extend childcare provision, to increase the amount that people can save tax-free for their retirement, so hopefully they work for longer, and also extending the amount of time that people can hold on to their benefits if they're long-term sick when they find a job. In terms of growing the economy, we're expecting a sweetener for business to try to compensate for the rising corporation tax that's planned for April, and this really will be presented as a budget for growth, but the question is, will he be ambitious enough? Because so far Jeremy Hunt has focused on steadying the ship. Now his MPs want him to show that he's got ambitions to point it in a firm direction.
What does that then mean for things like childcare, for example? What does the expansion look like?
Well, at the moment, there's free 30 hours for 3 to 4-year-olds. The extension would, it is reported by the Guardian newspaper last night, be extended to 1 and 2-year-olds if both parents are working at least 16 hours a week. There would also be an increase in the ratio of the number of children that one childcare provider can look after. Other tweaks in addition, but the question really is, how fast will this come in, and will the money be new money, or will it be a reallocation of money that's already there for early years spending? But this is a popular policy. It's one that Labour had been touting itself, the opposition Labour Party, and even economists that I've spoken to had said that childcare would be crucial because the UK has some of the highest childcare costs in the developed world. I spoke to Michael Saunders, the former Bank of England policymaker. He said that this could help not only to help labour market inactivity, but to grow the economy, close the gender pay gap, and indeed it might just be a vote winner with an election on the horizon.
OK, thanks very much for that. Thanks for joining us, Lizzie Burden, our colleague there, with the latest on the UK political scene. And apologies, is that the right word for the music in the background? I don't know, perhaps a reference to UK politics. In fact, I am pretty sure it was. Right, coming up later today, we will have extended coverage of the UK budget announcement. That special is live for UK viewers from 12:15 UK time here on Bloomberg TV. Elsewhere, normal service will continue, and that normal service will just reflect on some breaking news then, Chrissy, coming through from the UK on Ukraine. The Ukraine has won a UK Supreme Court ruling over a $3 billion bond default, so it won a significant boost in its attempt to set aside a $3 billion defaulted bond. This after this UK Supreme Court ruled that judges need to consider the backdrop of Russia's campaign. Russia had been trying to argue the counter there. But Chrissy, the big focus today is really on financial services, on banking stocks in Europe, very much weaker. Credit Suisse trades considerably weaker at new all-time lows.
Yeah, and really having an effect on the macroeconomic trade as well. This isn't just about the SVB collapse anymore. We know Credit Suisse has really been struggling for a very long time, and you can actively see how aware people are. As soon as those headlines come out, yields drop around the world and futures stateside as well, falling in tandem. So you're really seeing that today's mover may as well just be the Credit Suisse developments.
Yeah, absolutely. So financial services and Credit Suisse under pressure. That stock, as you can see there, down considerably over the last 5 days. Down on the other banking stocks, though, French banks under pressure, down by more than 7% on SocGen and on BNP Paribas. That is it for early edition. Surveillance is ahead. This is Bloomberg.